Cloud. So yes, we have started recording. This is about 8:03. I know people will continue to join, and I'll let them join as we go along. Um, Please remain on this call till the end because towards the end I have few things, few freebies that we will be distributing. I mean, just the email stuff. So just hang around till then. Uh, just a little bit about myself. I'm not gonna steal the thunder today. My name is Prashant Kumar, and I have my own company, My Realty Gains. I'm proud of trying to build that brand. My other companies' names are also Triple Chase Realty Gain, and I'm kind of following that, um, you know, naming convention for my companies. I have strong technology background and management background in the last 25 years in corporate America. Um, and like 5 years ago, I built the passion for real estate. And ever since I have started acquiring multifamily, single families and multifamilies. Single families first, then multifamilies. Currently, I have about 100 units in my portfolio, just two properties, but I work with as GP capacity with various syndicators, and I do syndication of my own too. So about 1,200 units that I have in GP capacity working. Along with multifamily, I'm fascinated by assisted living. So we started pilot projects in assisted living about 1.5 years ago, and we are working on some few projects on assisted living ground up development that will come probably a little bit later this year, but we are underwriting a lot of deals. So that is all about me. Having said that, what is one thing that everybody is afraid of in this business? Uh, uh, I would not be exaggerating that underwriting is one thing which people don't like to do. They know the numbers, but they are always scared of that. And in my mind, even though I'm very analytical, I do a lot of it, but I always have a little bit of a uncertainty because I'm not doing it like 24 by 7. So today I have invited, a great guest on my webinar. Hopefully we are going to create some value for you guys. Lance Chebin.
Thank
So
you, Thank you, Prashant. Thanks for having me on your webinar. Hi, guys. Great to meet you. A little bit about myself.
let me have that honor, Lance. Let me have that
Okay,
honor. Right?
rushing
Yeah,
in.
because you are my guest, I had to do that introduction. So Lance has been the founder and CEO of Almaz Investments. That's he is the owner, president, and CEO of that Almaz Investment is a real estate advisory firm focused on multifamily investments nationwide. Serving as one-stop shop, Almaz Investment advises investors on way to scale their investments through acquisitions, capital market, and asset management strategies. Lance's prior experience includes working with investors and owner-operators across the real estate spectrum, focusing on private equity and syndications, capital markets, asset management, and investment sales. So, I mean, he's one stop shop. I mean, today we are going to talk to him, pick his brain, and learn from him what he brings to the table and what are the strategies that he implements when he advises his clients and what kind of underwriting techniques does he use. So I'm very eager to talk to him at length about underwriting multifamily deals. So having said that, Lance, welcome to the webinar.
Take two, all right?
You take two.
Thanks again, Prashant. Great to be on your webinar. Hi, everyone. Great to meet you. And yeah, let's get started.
let's 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 just get started. Yeah, let's go deep. Whatever. So we are going to start whatever you want to start with, Lance. Stage is yours. I'm going to stop sharing, and at whatever point you need to start sharing something, please feel free to do so.
Sure. So, I mean, I think initially we'll talk about more of, okay, when a broker sends you a deal, when you get a deal, right? What do you look at? How would you do an initial underwriting? So, my background has been, as Prashant mentioned, has been primarily in private equity and syndications for multifamily deals. I worked nationwide across all different markets, did a lot of deals in Texas and Georgia, the Carolinas, Florida as well. Um, and so, really, what happens is when I'm screening for a deal, a broker would send me an OM and a rent roll. And before really diving into the numbers and seeing what's out there, does it make sense? I want to look at, okay, what's the value add opportunity? If this is a value add deal, right, one of the things that I look for is, does the deal have a 50% upside at least? Right? I mean, what percentage of the units are renovated? And if they are they fully renovated? Are they partially renovated? And with that being said, what's the upside premium? And that upside premium would come from both a comp analysis, which we do, as well as an on site visit to check out the property itself as well as the comparable properties.
So during an underwriting, Lance, would you ever do a site visit?
Yes, I think that's very important. That's part of the due diligence process. Because at the end of the day, as a real estate investor, you want to see physically where you're putting in the money and what can you actually do. Because from an underwriting perspective, if you look at a deal from just the numbers, that paints one picture. But when you're on site, you see it for yourself, what's realistic, what you can actually do.
As an underwriter, do you or some of your associates would go and visit a property to evaluate that, or the onus is only on the sponsor whom you are working with to give your recommendations?
So we can go and do the site visit, but generally it's the owner who would go out because we serve as advisors. But yeah, I mean, if he needs a second opinion, we would be glad to go out and give our take on it.
All right, please continue.
Yeah, so when it comes to underwriting, once we screen the deal, once we see what the upside is, we really want to get a sense of the market, right? Is it in a high growth area? Is there strong population growth, rent growth? What's the supply demand factors? Is multifamily investment a viable opportunity in that market? We also look at key economic drivers. What's driving the local economy? What kind of employment are there? Major corporate relocations? I know over the past several years there have been major relocations from the West Coast and from the North, particularly in New York, moving down to places like Texas, more specifically like Dallas and Austin, because the cost of living is much cheaper down there than it is up north. And so when you factor in those things, that's like a key thing that I look at when underwriting the deal. That's just more from a market perspective. Diving down into the numbers, we look at the rent roll. We want a strong rent roll, low vacancies, of course, if possible. But if it's a value add, you might be dealing with some of that. We also look at the T12, right? We want a stable T12, no major expenses. If there are, again, that's a value add opportunity where you go in and you're like, okay, expenses are high. Maybe we can implement some cost cutting measures, right? Implement a system to track how much water leakage is happening at the apartment. So there are definitely opportunities to look at that. And then we also look at the management, right? Is the management operating well at the property? Maybe we need to rebrand the property, restructure the management, bring in a new management firm. So really, it's all about being strategic when it comes to underwriting the deal.
Okay, no, very good. So I know you said that you have been involved, and I'm asking my question. Okay, there are people who have different questions. They may ask their questions, but um, uh, what are the sources of comps that you typically would look at? What are the different databases that you would look at to extract? What is the methodology to accept comps, basically, to see the
Right.
comp?
So when it comes to comps, there's sale comps and lease comps. So starting off with sale comps, I would look at CoStar. I would look at RCA, which is Real Capital Analytics. Those are pretty good platforms when it comes to comps. And when actually searching for comps, I want comps that are comparable to the property in terms of size, whether it's square footage, definitely unit size, year of construction, vintage. And also, I don't want non-arm's length. I want comps that are relatively close because that makes a really big difference. When it comes to lease comps, I look for comps that are renovated, especially if it's a value add deal. So I look at comps again with similar, the properties, they have to be of a similar size, similar caliber, but the unit rent interior renovations, they need to be upgraded because then you can use the increase the rent as a comp, and that's what you can gauge whether it's if the a premium that you're trying to get, if it makes sense.
Nice. So each market is different. The labor cost is different in each market. How
Correct.
do you how do you adjust how do you adjust the renovation cost depending? I mean, if it is Atlanta, it is different. If it is Houston, it is different. It is
Yeah. So from my experience, we would work in tandem with property management firms who are on site, who know the market better and deeper. And so we would consult with them to see what are the realistic labor costs. Now, it's one thing to make assumptions, high level assumptions when you do the initial underwriting, but when it comes down to sharpening the pencils, if you will, that's when you should really have accurate numbers, budget numbers as to okay, how much is it a cost per appliance, cost per door, uh, etc. Yep.
okay. No, very, very good. So yeah, I'll let you continue. I have many, many, many questions, but I'll ask maybe a little bit later.
Sure. So one thing I know we talked about comps just now. So I want to actually share my screen, show you a little bit of a model that shows a comparison when we do a lease comp analysis. And the question comes, okay, what's the premium? What's the upgrade that we could do if we're doing a value add? How much more of a premium can we charge our tenants once renovations are done? So let me just quickly share my screen. So can everyone see?
Yes, we can see. Yes.
Perfect. So right here, this just shows a deal that I worked on. It shows the unit mix, the square footage, the units, bed bath count, current rent, stabilized rent, which means the current rent is what the property is generating now. Stabilized rent is what's going to happen after we do renovations, and the dollar per square footage. Now, we look at it, the average apartment size is it's a 250 unit property. And we're saying an average apartment size is about 819 square feet. We're saying that 50 units have a standard to modern renovation program, meaning they're classic. The classic to modern renovation is about 120 units. And we're saying that for the first level, it's going to cost about $10,000 a unit. And for the second level, about 5,000. Now there are 80 units that are fully renovated, so we're not touching that. So we're assuming that we're going to do renovations on 68% of the property. So here we have an option. We could either do a premium on a general, which shows just 75, and it shows the delta changes in our rent versus the market. Or we could do a further breakdown that shows a specific and what the upgrades would be for studio or efficiency units, 1 bedroom, 2x1, and 2x2s. And you could see that the rents are increasing. Now here it shows our market average per square foot, our average per square foot, and the delta, which is the difference. Now, where are we getting the difference and the deltas? This comes down from our comp page. So the comps, I went and I did a comp analysis. So this is our property. We're looking, it was built in 1984. So our comps are averaging about 1985, right? Which is
Yeah.
in line. 250 units, 240 units. When I went for the status and trying to find the rents, I went primarily for renovated looking interiors.
Mhm.
So here we have the average, the rent, we have the property average, and then we have an upgrade average. And we have that going for both of our studios, 1 bedroom, 2 bedroom, 2x1s, and 2x2s. And so what's happening is if we go back to our assumptions page, we see that the market average per square foot is pulling from the comps. And this is pulling from the rent roll, our model. So we could see that the difference in what we have and what the market is and the difference. And this basically shows us how much of a premium we could generate off of the comps.
So is the purpose of this exercise that you are trying to understand whether you want to do the upgrades on classic units or you want to do the upgrade on standard units so that you can create more value? Is
Correct. It's to show what percentage of the units need to be renovated, how much, and when it comes to comps, it serves as a gauge to see, okay, the broker says, like, I mean, those who have underwritten deals, I'm sure you can agree, when you receive an OM, you look at a property, the broker says $150 premium.
yeah,
Well, the question is where is he getting that number?
yeah.
Is he coming, where is he pulling that number? This exercise is more of a realistic gauge of, okay, we're on the ground, we see what other properties are charging for similar type of product. What's a realistic number? So if the broker comes back and says, hey, it's 150, probably I'm going to underwrite it at maybe 100 or 125, just to have that a little bit of a cushion. So that's how I look at it.
Very good. Very good. So there is a question here. Do you do you also have a situation that existing unit will rent for a higher amount currently
Well,
below market, and how do I take care of those?
so you want to say you have a current tenant in place. He's paying below market, and you want to renovate and you want to charge a higher rent, correct?
Can I
I think,
speak up?
yeah, go ahead, Rick.
So, so we at last we are talking about a situation where, yes, some of the units are either already renovated or are still in classic, but they are still below market. So, in this model, can you take care of those as well? That hey, I have a situation over here where I can up or raise the rents for existing ones, but obviously after the current lease expires on those, but I probably don't need to renovate those as well.
So yeah, I mean, you definitely can. I mean, I've seen a lot of firms where they just increase the rent every year by a certain percentage. Usually, from my experience, what I have done is when you acquire a property, right, you basically have a 2 to 3 year renovation program. And so as the leases expire, you increase the rent. Now, if the tenant doesn't want to pay that rent, he would vacate. And then you're going to have this item called turn make ready, which is a down unit that you are renovating. Once it's renovated, you lease it up at the higher rent. So basically, your tenant, he's either going to pay that rent or he'll be forced to vacate. And then once you renovate that unit, then you'll be able to charge that higher rent. So
So
that, yeah,
basically
go ahead.
letting the loss to lease burn off. You know,
Exactly.
time will come. The tenant will have to. I mean, is the time for you to renovate the unit if it is not already renovated, and at that time you are gonna either move the tenant to some other unit, or you know, basically you have to raise the rent anyway.
Right. Yeah. So basically, as the renovations are happening and the rents increase, you're slowly burning off the loss to lease. So that's another value add strategy that we look at, right? So I think that's very important as well.
Very good. Very good. No, please continue. Please continue, Lance.
Yeah, so I mean that's basically what I wanted to show about the model is when it comes to the comp analysis, how we see, and here you could tell at the bottom through our renovation program, we're going to increase the gross potential rent from 241 485 to 267,000, which is a significant increase over a short period of time, and it's only going to grow from there. So, yeah, that's basically what I wanted to show to share. Are there any questions? Anything I could help out with?
So,
Clarify?
yeah, so I have questions. What measures have you taken during COVID, in terms of, extra need for capital, banks needing extra need, like extra reserves? How have you, what have you done in your model to make sure that we are not, letting our deal, slip off our hands because we have to raise so much money, so much extra money?
Sure. So one thing that we did was with growth rates. I had a firm I was working with. They wanted year one -1 growth rates,
Mhm.
because the risk was and the fear was that tenants may not be able to pay rent. But as we know, collections have been pretty well despite COVID fears. So
Yeah.
that was a very, very conservative move on their part that they wanted to do.
Mhm.
The lender reserves, we increased it. Here it says 300, but we actually were underwriting it at 375,
Mhm.
just to add more of that cushion. You have COVID reserves as well,
Mhm.
which went into effect. And we really tried to underwrite the deal based on an as-is basis, without any renovations, without any cost-cutting measures. We wanted to see, okay, how is the property doing today, now,
Mhm.
with all of the expenses? And then if the expenses were really high, then we could go in and really start cutting. Okay, do we cut payroll? Do we cut advertising? What do we do? Um, Another thing is that I noticed that tenants really want their privacy and the space. So that's another thing that we try to look at the building, is what can we do inside the property to see, okay, how can we provide that for the tenants as well?
Very good. Very nice. So there's a question here in the chat. Which, somebody's asking, Jay is asking that, what is the model, underwriting template that you use? Is it custom made for your owns? You have made it for yourself, or is it something, I guess,
Uh,
yeah,
yeah, no, it's something I built. It's something that I built, but again, when it comes to deals, there's no such thing as the same deal, right? No,
yes,
no deal is the same. So when it comes to modeling out the deals, you got to be creative. Sometimes I use templates, other times I'll just build it from scratch. It really depends on what's needed to get
right.
done.
Right. So, I mean, there are a bunch of deal analyzers out there. A lot of people know about Michael Blank's SDA for beginners, so to say.
Right.
So people use that, and there are a lot of um, more enhanced versions of them available on the. Uh, I mean, I don't remember anymore. But I did a course once, about a year or two ago, and I must, please remind me. I will look for it, and I will probably let everybody know. Um, which models were these? So my friend John is asking, have you modeled waterfall and refinance returns in your
Yes, I
model?
have.
You do.
Yes, I've done waterfalls, GP, LP, IRR,
Yeah.
Bay IRR hurdles. Yes, I've done that. I've done preferred equity. I worked with different debt schedules as well,
Mhm.
bridge financing, mezzanine financing. So
Yeah.
whether it's modeling it or presenting it to lenders, so I've done it all.
Yeah, so yeah, those are typical things that we do anyway. I mean, in our all our deals, you always have refinancing. And I mean, we have done, even in one of the deals, we have done like refinancing it two times,
Right.
over the 7 years period. So we had
Sure.
modeled that also once. And there are a couple of complicated models which support that kind of deal also. But for our purposes, as a syndicator, we are not the private equity groups, not that big. So we don't do that kind of things. But one refinancing is good enough for us to project over 5 year period.
Right.
So
Yeah, I mean, what I've seen is that if it's a value add deal, generally it's a 3 to 5 year hold. You
mhm,
go in, you do about 2 years of renovations. Once the renovations are down, you do a cash out refi, pull the equity out, and then
mhm.
sell it in 3 years, and everyone's happy.
Very good, very good.
Yeah.
So John, for Lance, I will take a 1 minute break, and I'm gonna talk a little bit about. And I don't have a slide today, and I'm just gonna talk about what we have in pipeline. A couple of things that we have in pipeline for our listeners. Number one is we are in the process of starting a fund of funds, basically, in which we will be, the goal of the fund would be to have investors and investors investing in specific deals. It's not a blind fund, it's just investors investing in specific deals. So we are working on that right now, and just a communication, right? In addition to that, there are a bunch of activities going on. There are a bunch of deals that we are working on. It actually, 2 or 3 deals are closing in Houston in May, and all of them have approximately, double your money in 5 years kind of returns at a very conservative level. So anybody who are interested, please reach out to me. If And again, because it's a closed group, I can talk about it because it's a 506B, um, and I'm not soliciting, but I'm communicating that there are deals that we are working on, which probably would close in May time frame. There's a deal that we are working on, 1,300 units, $117 million project that we have under contract, and we are in the raise right now. And you know average cash on cash of about 9.5%, starting with 7.5 from first year up to 11%. So average in 5 years is like 9.5 cash on cash, IRR of 17%, and about 2x in 5 years. So, I mean, the goal basically for us is to provide conservative projections. And even with those conservative projections, our personal goal is to at least create 0.75, 75% value for investors in 5 years. So with an annualized return of 15%. For the deals that we are working on, on the conservative, with all the conservative underwriting, in Houston, good areas, we are able to produce up to 2x returns on those deals. So I am not sharing the name of those deals, but big projects, 130, oh, I'm sorry, 1,300 units on one project, four properties very close to each other. That is basically on the radar, $117 million project. Anybody wants to know more information, please reach out to me. I will be able to share more information. So yeah, that's all. And Just stay put. Towards the end, we are going to share some freebies. Um, so let's continue with Lance.
Yeah, so I just got a question asking if there's an assumption in the model where it shows how many units are renovated every month, and if there's like a timeline or schedule. And there is, and that's one thing that I do. And the way I do it is it's really based on the total number of units at the property, which in this case it was 250 units, divided by the number of renovation months. So in this case, it was 22 months. So you do 250 divided by 22, you get your answer. And that's basically a projected estimate of how many units should be renovated each month.
So
And
that's a linear scale, basically.
linear scale, yeah.
Yeah.
Obviously, once you start doing the renovations, you have a different schedule. You might have delays that will be adjusted, but from a high level overview, that's basically the goal. That's how we look at the deal.
Yeah, you will build in the delays, instead of renovating 4 units, you will say 3 units per month.
Right.
And maybe you can pick up a little bit more some month, and some month you may be able to slack a little bit.
Right, exactly. But generally, that system, it's a linear system. It gives you a basic idea of how many units on schedule should be renovated each month. And so another question is, what is the source for estimating the rents, the rent comps? Like, where do I get the assumptions? Great question. I use a number of sources, one of which is apartments.com. That's one way that I go to see what the renovated units are. I see the pictures and I see what the currently available units are so that we could accurately account for that. I also look at REIS. REIS is a good database to look for both rent comps and sale comps, but mostly rent comps. So that's the databases I use.
So one thing, Lance, you said that you have worked in private equity, right?
Correct, yeah.
My question is, are there databases out there where, uh, you know, private equity partners can be found? I mean, like, you know what I mean?
Yeah, there are databases where, and I unfortunately don't have the name off the top of my head, but I've definitely did come across some databases where they have a network of global family offices that like to invest in private equity on different types of investment strategies. And so, yeah, there are where you could sign up and network with potential clients that are family offices. Yep.
Okay. So, I mean, yes, I know. Of course, we have the databases for the family offices, but besides that, I don't know if anybody else knows in this group right now.
Well, in terms of family offices, they invest in private equity as well. So if that's a strategy, you could look into that. But specific private equity databases, no. I don't know, not for real estate at least.
Got it. Okay. Okay. Anybody would know the answer of that? I'm just asking a question openly. Hopefully you can create value for others. Um, I mean, of course, we know that familyoffices.com, you can find a lot of family office. You can buy the database for family offices. And I mean, if you have guts, you can reach out to them when you have a deal, um, and see where it goes. But that's the only source I'm aware of. I mean, unless I have built relationship with other private equity investors directly, I do not know anybody else. This was the reason why I asked that question. So, um, yeah. So basically, guys, are there any more questions? Anybody wants to ask anything specific? Lance is here. He's our captive guest for another 15, 20 minutes. So feel free to shoot your questions, guys.
I got a question.
Sure.
Hey, Lance, thanks for doing this. Appreciate it.
Hey, Jay.
Yeah, good. How are you?
I'm doing well.
All right. So before offering the LOI, do the sellers generally provide the rent roll and P&L statements, or no? Is that only after LOI?
So before, yeah, no, you should get the rent roll, the T12, and the OM, the taxes, basically everything before you submit the LOI. LOI is basically your intent to move forward with the deal. So you should have the deal underwritten before that. At least do an initial underwriting prior to submitting an LOI.
I know why Jay is asking that question. 99% of the time, Jay, what Lance says is correct. You should have all the information with you before you submit an LOI. There are a bunch of wholesalers out there who wants to show you like one-page rent roll or something and wants you to submit an LOI so that they can get the information released from the seller. So that's just something which wholesalers uh, do to basically to gauge your interest level, and that LOI has really no meaning because you do not have any information about the property.
Right.
That really has no meaning at all. I mean, if at all, you will have to write another LOI after you receive all the information.
Correct.
Because with all the information that you have, T12, rent roll, OM, taxes, anything and everything, with that information, you underwrite the deal and you say, listen, this falls in this range. If it's 10 million plus minus 10%, so you
Right.
say, so I'm going to put an LOI. Otherwise, if you don't have that information, you're just taking a number out of your head, and that
Right.
means nothing.
Right.
Yeah, that makes sense. So are they obligated to give us the real information, or can they try to not give us real information and then we're kind of like in trouble? Is that generally how it goes, or the numbers that you're gonna get, the rent roll you're gonna get, that's the actual rent roll?
Those numbers have to be real.
Yeah.
Okay.
They have to be real. Otherwise, a lot of people are in trouble.
Yeah, those numbers have to be real. And if you
Yeah.
feel that they are not real, you have the right to ask them to be. You have the right to get them audited.
Right. Yeah, because once you sign the LOI, you can obviously ask for all these things, and then they're doing the due diligence and everything after the PSA. But I wasn't sure if you can ask for this information before LOI. So yeah, thank you for explaining that.
You will always have this information at your hand 99.9% of times, unless you are going through a wholesaler. And for obvious reason, wholesalers, they are swapping the emails back and forth, and they don't know whom they are talking to. And they do that, and that's unfortunate. But if you feel that rent roll is not legitimate, you have the right to get them audited, because
Yeah.
and you have a clause in your PSA that any rent roll submitted, you would basically, you have the right to review it in the property management system also. So if you are a little bit suspicious, better do the due diligence. Otherwise, if it is 90% occupied versus 80% occupied, that's a big jump in the price. Right.
Got it. Yep. Very helpful. Thank you, guys.
Yeah.
Sure.
Yep. Any more questions, guys? I know I had originally promised that I would share some things, and as I said, a bunch of things I told that we are working on a couple of deals. One is 1,300 unit deal in Houston, $117 million project, 2x, 9.5 cash on cash, 17 IRR, and 20% annualized, 2x in 5 years that I'm working on, and similar smaller deals in Houston. Everything is in Houston right now for some reason. I live in Long Island, New York, but these are the deals that I'm working on. But I wanted to share few things because just to, and I'm going to share my screen here. Share my screen. And then after that, we are going to break into smaller groups. We are a bunch of people here. I have created a 7-day passive investment email course for my friends. I mean, it's all free stuff, so please feel free to register if you want to register. 7-day passive investment email course, and I have a passionate passive investor club also, which is a little bit deeper. 7-day passive email courses at a higher level, which tells you what is passive investing is, what are the benefits of passive investing, and then you go a little bit deeper in that club, passionate passive investor club, where you have a little bit more information. So that's just simple, no obligation. Feel free to take this link, and I'm going to put that in the chat window for those who want to register themselves. Nothing, again, as I said, no, there's no obligation of any sort. And I have kept that link here in the chat window. Guys, feel free to share your contact information with others. Okay, towards the end of the meeting, we will ask everybody to copy, do a control A, or save chat. You can do a save chat, the 3 dots in your chat window on the right hand side. You can save the chat towards the end. But if you want to talk to me, basically myrealtygains.com/schedule appointment. You can schedule some appointment with me on my calendar, and I'm gonna put it in the chat window in a bit. So having said that, anybody has any more questions, direct questions? Otherwise, I was gonna break into smaller groups so that you can have more one-on-one interaction, if that's okay with you. We have about 10-12 minutes. I mean 15 minutes actually. So feel free. We have about 15 minutes, so I'm gonna break into smaller rooms. Anybody has any question, guys? Or did I miss anybody? So Kathy is asking, Kathy, I'm here for you. I'm looking for co-GPBC in Texas Triangle, Huntsville, Rawak. I'm here, Kathy. You know me. So feel free to reach out to Kathy. You are on mute, Kathy.
I know. I'm going to call you because I want the details.
Yes, you are welcome. You are welcome. Please feel free to call me anytime. And looking for my first deal as GP asset manager, boots on the ground in Texas and Oklahoma. Trevor, right? Trevor Thompson. Very good, Trevor. Thank you so much for your message. And once again, I'm going to break into smaller groups right now. And feel free, guys, to talk I'm going to just create, like, how many of us are here? We are about 15, 16. So I'm going to break into 3 or 4 groups. Okay. So if you lose me after 10 minutes, I'm going to close them and we'll come back here. Okay.
Sounds good.
All right. Open all rooms. All right, guys. So you can go into your rooms slowly, and we'll be back in 10 minutes.